Hi, and welcome to our course on stop losses and how to set them up. So your stop loss is really your safety net in the stock market. And think of it like an emergency brake on your car. So a stop loss is an automatic sell order that you put in place after buying your stock. You put in place this automatic sell order, and that will sit there and it'll trigger when the stock price hits the certain price that you've set, protecting you from a bigger loss. So for example, let's say you buy 100 Ryanair stocks at 20 euros and you set a stop loss at 18 euros. So if the price drops to 18 euros, your shares will automatically sell and you limit your loss to 2 euros a share. Now, if you didn't have a stop loss in place and if the shares actually fell to, for example, 15 euro, well, then you're going to be down 15 euros or 5 euros per share, which is significantly more. So you're just limiting your exposure by putting in a stop loss. You have an example here on the screen, which is taken from the DeGiro trading platform, and you can see how we've set up a Microsoft stop loss with the current price of 500, a stop loss trigger at 450, and we're setting this at good till cancel, which means that the order will stay live until we cancel it. So the alternative to this is to set it for the market day that we're in, so it'll cancel at the end of the market day. But we've let it, we've got good till cancel, which means it's going to stay there until we come back. So it could be there for weeks or months. Now it gets a little more interesting when we start looking at things like trailing stop losses. So this is a more sophisticated way of using a stop loss. So unlike a fixed stop loss, a trailing stop will move up automatically when the stock price moves, but it never moves down automatically. So it trails behind the stock like a sort of loyal dog at a safe distance. So in this example here, which is taken from the Interactive Broker platform, we're buying Microsoft again at 500. We set a 10% stop, trailing stop, giving a trigger price of 450. So if the price rises to 600, our stop will automatically move up to 540, which is still 10% below the 600. And if it climbs again to 700, the stock will move again up to 630, again 10% behind 700. Now, if the stock falls from 700 to 630, it'll automatically sell. And that will be the end of the trade. So we'll have locked in most of our gains. So this is a much more sophisticated way of doing things. And again, it's got all the same options as the DeGiro platform. So you can see exactly there where you can set it at 10% or you can set it at an automatic fixed figure. And again, we've set it to good till cancel. So now we have another thing which is on the buying and selling side. They're called limit orders and market orders. So we'll just clear up the confusion between limit orders and market orders. So when you're saying a market order, you're saying buy or sell the stock now at whatever the current market price is. So it's immediate and it's unpredictable, because while you might be buying popular stocks and they execute immediately, if you buy stocks that are more volatile or there's less liquidity in them, they can take a bit longer to buy, and you might not get the strike price that you're expecting to get. Now, a limit order, on the other hand, is been a little more specific, that you're saying, I only want to buy if the stock is a certain price or better. So in this example, we have €5.15 or better. So, or I'll only sell at a certain price or better. So if the price is, let's say, €5.30 or higher, well then it'll sell. And if it's €5.15 or better, it'll buy. Now, in our example here, we can see on a market order, we're looking to buy Microsoft and the current market price is 500.66. And we put in an order to buy that quantity of 10. It'll probably hit that price immediately and we'll get filled our 10 stocks, because Microsoft is very liquid and there's no real issue there. On the limit order, we're saying we want to buy 10 stocks, but we want to buy if the price is 490 or better. So if the price of Microsoft is bouncing around a bit, or any other stock, it may fall down through the day and hit 490 and then get filled at that point. So limit orders are very good for volatile stocks where you want to buy, for example, on the dips that the stocks have. So if you look at the charts for some of these volatile stocks and you can identify where support levels exist in the dips, and you set your limit order a little bit above those support levels, then when the share price falls into that dip zone, you should get filled so long as it falls down to the support level that it traditionally does on the volatility. Then you ought to get filled if your limit order is a little bit above that support level. So we'll have a look at some scenarios here of how a setup might roll out. First one here, we're looking at a stop loss. So Siobhan buys 200 shares in the Kerry Group at €100 each, hoping for it to climb. So she sets a stop loss at 90 to protect herself. And then Kerry releases disappointing results. The stock opens down at 88, blowing past her 90 stop. So her stop loss triggers, but she actually sells at 87.5 due to rapid price movements, and she doesn't have a limit order in. So stop losses don't guarantee your exact price in a fast moving market, and they guarantee an attempt to sell once the trigger is hit. So Siobhan limited her order to about 2,500 instead of potentially watching it drop to 75 per share. Now another scenario would be we've got Liam. He buys Flutter Entertainment at 150 a stock within 15% with a 15% trailing stop. Initial stop at 127.50. So once the 127.50 is hit, it becomes a limit order at that point. So what happens? So Flutter climbs steadily to 200, stop now at 170, then to 220, stop moves on up to 187, and then it moves further again to 240 and stop keeps moving up. This time it's at 204, and suddenly the market turns nervous. Flutter drops to 204.50 and then to 203.80. So Liam's trailing stop triggers at around 203.50. So what's happening here, Liam entered at 150 and exited at 203.50, a 36% gain, which is pretty good. So a fixed stop loss at 135 would have left him in the position, but he might have panicked and sold poorly. A trailing stop did the thinking for him, took the emotion out of the situation and locked in most of his profit. In this scenario, it's about limit orders. So Aoife wants to buy Bank of Ireland, currently trading at €10.50. She thinks it's slightly overvalued and sets a limit buy order at €9.80. So for 2 weeks, nothing happens, and then the ECB makes an unexpected announcement and bank prices across the board dip, and her order executes at €9.75, even better than her limit. So what happened here was the limit order requires patience, but they ensure that you're getting the price that you want, and 3 months later Bank of Ireland is back up at 10.80. Eva's already up 10% because she waited for her price. So her impatient friend maybe who bought at 10.50 and didn't have a limit order in place would only be up 3% compared to Eva's 10%. So our final scenario is where a market order goes wrong. So for example, let's say Connor sees Smurfit Kappa announce a merger. He immediately places a market order for 500 shares and he sees the price at €45. So what happens? The news spreads very fast. By the time his market order executes 3 seconds later, he's paid €47.20 per share. That's 1,100 more than he expected across the 500 shares he wanted. So the market orders on news-driven moves can be quite dangerous because there's so much activity in the market at the time. So a limit order at 45.50 might not have been filled, but Connor could have assessed the situation then after that, and in volatile conditions he might be able to consider putting in a limit order or coming back into the market at a better time. So how do you know what type of stop to use? So you use a regular stop loss when you want a protection over a short-term trade. A stock is volatile or risky. You're dealing with individual stocks and not indices, and you have a specific loss that you just simply cannot tolerate. You'll use a trailing stop when you're in a winning position and you want to ride the wave of the trend. the stock is showing strong momentum, and you'd really be kicking yourself if you sold too early. And finally, that you're maybe going on holiday, or you're in a situation when you can't monitor what you're doing. And you can switch between these situations. So once you put in a standard stop loss, if you want, you can change it to a trailing stop loss. You're just going to have to cancel the standard one and set up a trailing one. And finally, we'll have a look at some of the best practice and common pitfalls that people come up against when they're using stop losses. So in best practices, you don't want to set stop losses too tight, because they'll get hit too often and you'll be cut out. And in order to buy back in, you'll be going through extra costs that you didn't need. So consider the volatility and check your stock typical day range, so you'll know where to set your stop loss. You can do that through a screener where you look at average true range, and that will give you an idea of what the range is. Review it regularly, so don't leave stop losses on for months on end. You have to keep going back in and tighten them up and look at them and make sure that they're still useful in respect of the position that you're holding. Use multiple exits, so you can maybe sell part of your holding at a limit price, part as a trailing stop. You can mix and match some of these. You don't have to put one type of stop loss on your entire holding. You can take portions of it and build up your safety net that way. Common pitfalls, the same one keeps coming up all the time. You get too emotionally involved in things, so you never move your stop loss further away to avoid being stopped out. So you don't want to, once you put it in place based on the thinking that you have at the time, you don't want to let emotion get in the way of your thinking again, and then you make an emotional decision thinking that you're now Gordon Gekko and you're making loads of money. So ignore gaps in stop losses, accept the risk, avoid holding through earnings as well. These are dangerous times to be holding any stocks, really, because you've no idea what's going to come out in earnings. Weekend gaps, they would be also truly unusual times to be holding stocks, again, where there's news can come out over the weekend and the stock opens lower on a Monday morning and it's gapped down past your position, so it sort of jumped over your position rather than passed through your position. Now there is an insurance that you can get to cover that, but you end up paying a much more expensive stop position. So set and forget, that's where a market changes. So a 10% stop during calm times might need to be a 15% stop during volatile times. So use your stop losses appropriately and basically use common sense to try and get the stop loss to fit in with the current market conditions. So finally, just to conclude, stop losses, trailing stop losses, order types, they aren't just technical jargon. They're really the difference between investing with a plan and gambling with hope. So I leave you with this. The best investors I know aren't the ones who pick the most winners. They're the ones who manage their losses brilliantly. So Warren Buffett's first rule was don't lose money, and his second rule was don't forget the first rule. So what you really need to do today is to log into your platform, review all the positions that you have without any stop losses, and then figure out the appropriate stop to apply based on what we've gone through here. And then write down your rules that you want for that particular holding, and then stick to those rules.